There's a fundamental misunderstanding in how most people relate to their jobs today. More and more, I see employees anthropomorphizing their employers. They think of the company as a person, a living, breathing entity with a conscience and a sense of morality. They're told that we are a family, we grow together, etc. But when they get passed over for a promotion or laid off despite working weekends, they feel shocked, betrayed even. Now, this emotional attachment to a company, especially in white collar India, is not just naive, it is dangerous. Because at the end of the day, a company is not your friend, not your family, and certainly not a moral actor. It's a construct created for one single purpose to generate profits for its shareholders. And to that end, it enters into relationships with customers, suppliers, regulators, and yes, employees. And the employee employer relationship is fundamentally a transaction. You give your labor and you get your salary. That's it. Everything else, the ping pong tables, the culture decks, the town halls, are window dressing, often designed to make you stay longer and work harder, and in many cases for less. Now, this matters because it shapes how a new generation of Indians sees work, money, and by extension, investing. We're not dealing with the 1990s generation anymore. Today's retail investor is more aspirational but also more disillusioned. They have seen what happened when the system does not reward loyalty. They have understood that if they don't take care of their finances, nobody else will. But here's the catch, they are stepping into a market and an economy that is undergoing deep structural changes. And unless you understand what's shifting under the surface, you'll be stuck playing by the old rules in a new game. So let me talk about that game. For the last 30 years, India's white collar economy has thrived on one simple premise: cost arbitrage. We exported services, IT, BPO, KPO, to the West at a fraction of their local cost. We had surplus engineers, low wages, decent English, and a globalizing world that wanted to cut costs. We did not need world class IP, branding, or even breakthrough innovations, just warm bodies with degrees. Now, in management fee, India becomes a loss leader, like DMart selling you pressure cooker below cost to get you into the store. Our value was in bulk. We offered scale and not sophistication. Now, that model worked until now. With generative AI and automation threatening to make large swathes of white collar work redundant, India's services engine is entering a period of stress. What happens when AI can write code, answer support tickets, and do basic accounting, and even design PowerPoint decks faster, cheaper, and better than a fresher from Bangalore? We're already seeing the cracks early. Hiring freezes at few major IT firms, fewer campus placements, TCS reporting record deal wins, and still posting revenue degrowth. Now, the West is not increasing outsourcing, but they're automating it. This will have downstream effects. Less job growth means lower wage growth, which means weaker consumption. And that is another sacred cow that we'll have to confront. For years, India has been sold as a consumption led economy, the billion person market, the middle class dream, the next China. But scratch beneath the surface and the story begins to fall apart. The so called Indian middle class that drives this consumption, how big is it really? Well, according to Pew, only about 6% of India earns enough to be considered globally middle income. The rest are poor or barely scraping by. Even the top 10% of earners who drive most urban consumption are facing pressures of EMIs, school fees, rent, inflation, and a growing sense of financial insecurity. Now, combine that with the weak white collar job growth that we just talked about, and the fact that the formal manufacturing base, which could have absorbed labor, was never meaningfully built. So, the result, a demographic dividend that risks turning into a disaster. So, if jobs are not growing and consumers are not spending, then what is driving GDP growth? Because remember, we still have 6.5% growth. Well, the answer is simple: the government. In the absence of private demand, the Indian government is stepping in with a fiscal bazooka. Capex led growth is the flavor of the decade. We are talking highways, railways, ports, airports, power, defense, you name it. Public sector capex in the budget has crossed 10 lakh crore rupees annually. And it is not just about the numbers, it is the signal. The state will spend even if the private sector will not. Why? Because that is the only way to keep the engine running. Creating jobs, building infrastructure, lay the foundation for future manufacturing. And while we are at it, hand out targeted subsidies and welfare transfers to keep the bottom half afloat. This is not liberalization. This is state led growth with the government as the investor, builder, and consumer in chief. For investors, this changes everything. From 2000 to 2020, Indian equity markets were driven by a simple formula: play the consumption theme. FMCG, retail, private banks, autos, consumer durables, capital light businesses. High ROC, brand driven growth, get in early, hold forever, and sip your way to alpha. That era is ending. The next decade will be about capital heavy businesses: infra, manufacturing, logistics, defense, utilities, energy transitions. Businesses that have physical assets, long gestation periods, operational complexity, and often government linkages. Now, this is the great capital rotation and it is already underway. Look at the recent outperformance in the market: defense, PSUs, railways, auto ancillaries, power, and capex players. These were dead money for a decade. Now, today, they are multi baggers. Why? Because they are aligned with the raw engine of growth, the state, and they are solving real bottlenecks of logistics, synergy, national security. This shift will have many legs, from consumption to infrastructure, from services to manufacturing, from capital light to asset heavy, from branding to execution, and from digital to physical. And if you're still looking for the next Nika, you're missing the big picture. What this means for investors is that the quality compounder basket is now overcrowded. Everyone owns the same 50-60 stocks and they have been bid up to absurd valuations. Meanwhile, the so called dirty sectors, old economy names with factories, warehouses, working capital cycles, and labor intensity, are where the action is. Let me give you an example. A company in Rajasthan that manufactures heat exchangers, which is a boring industrial product used in power, oil, gas, and chemical sectors, is currently trading at 100 times PE. Why? Because it has order visibility, execution strength, and a product that will see demand for decades. It is not a tech company, but it is not a brand, but it fits the new thesis. There are dozens of such stories that are playing out right now in chemicals, precision engineering, industrial automation, EV components, cable manufacturing, container shipping, and many more. So, what should you look for? Strong order books and execution track record, low debt but not necessarily asset light, insider ownership and skin in the game, government policy tailwinds, robust working capital and supply chain strength, and maybe most importantly, valuations that still have room to re rate. But be careful, this is not a call to blindly rotate capital into every PSU or capex stock. Many will be value traps, some will be frauds, others will be cyclical and burn you if you mistime the cycle. So you still need to do the work. Read annual reports, study sectoral trends, and understand commodity cycles. Talk to management, visit plants, track order inflows, and look at promoter behavior. This is not a game of narratives, it's a game of sweat and detail. But if you get it right, this is where the next wave of wealth creation lies. So, zooming out, there is also a geopolitical undertone to all of this. As China slows down and the West decouples, India has a real shot at becoming a manufacturing alternative, especially in pharma, electronics, chemicals, textiles, and defense. But it won't happen on the back of slogans, it will happen on the back of factories, and that is where the capital will flow. So, expect to see FDI in hard assets, not just in tech. Indian firms expanding their global footprints, strategy plays in ports, pipelines, grids, etc., increased M&A in industrials, and supply chain clusters being built around states with infra readiness. So India's China plus one moment is real, but it will favor the companies that build, not the ones that brand. We are entering a new economic regime. The old playbook of ride consumption, buy digital, avoid capex heavy stories is losing steam. The new playbook demands a shift in mindset, tool, and analysis. This is not a sexy story. It is not the startup boom of 2021. It is a harder, messier, and more operational situation. But that's exactly why the opportunity is real, because most people will not look here until the multi-baggers have already happened. So, as a research analyst or even just an informed investor, this is your edge. If you want to stay ahead of these shifts, I share these insights regularly on my YouTube channel and in our Telegram group. We break down market trends, analyze stocks, and track themes like the great capital rotation as they unfold. Subscribe to the channel, join the Telegram group, and if you found this useful, share it with someone who will think consumption is king. The future of the Indian market is being built right now, quite literally. Are you paying attention?